Hello, my name is Holden McGinnis, and tonight we will be discussing private placement, due diligence, and term sheets. Private placement offerings. Before discussing the Private Placement Memorandum, or PPM, it is important to first discuss the Private Placement Offerings, or PPO, because without a PPO, there would be no need for a PPM. Private placement offerings take place when a company wishes to sell securities of their company to an individual investor or group of investors in order to raise capital. Due to strict loan criteria from commercial bankers and institutional venture capitalists, PPOs are one of the most viable options to raise capital for many types of companies, whether they are startup, carry high levels of risk, or simply wish to maintain privacy in their business. Advantages of a PPO versus an IPO. There are several advantages of the PPO over an IPO. These advantages include lessened costs, less time legal process, and hand-picked investors. Before an IPO can take place, there are several steps that must be taken in order to successfully place the company's securities. Without going into too much detail on the anatomy of an IPO, consider the cost of finding a broker and an underwriter, deciding on a price to list the securities, and deciding which contract method the underwriter will use when listing them, be it a best efforts contract, firm commitment, all or none, or a bought deal. Suffice to say that the process of an IPO is an expensive one. A PPO, on the other hand, bypasses all of the previously mentioned costs and greatly reduces the time spent, though some time will be spent valuing the company and deciding on a price to sell the securities, as well as finding investors. Another considerable advantage of a PPO is the ability to hand-pick investors. Having investors with knowledge and skills readily available that are as eager for the business to succeed as the owner is an invaluable asset. Disadvantages of a PPO versus an IPO. While there are numerous advantages to PPOs, there are also some drawbacks that must also be considered. It is oftentimes difficult to find investors who are not only interested, but can contribute positively to the company, be it through advice or financially. Finding enough investors to contribute in order to raise the desired funds may not always be easy. Making matters worse, PPOs must often sell at a deep discount in order to attract investors who are willing to take on the additional risk of a startup or other risky venture, which can make raising enough capital even more difficult. What is a prospectus? A prospectus is a financial document that provides the financial information of a security for potential investors. A prospectus is commonly used to provide information to investors about different securities, including stocks, bonds, mutual funds, or other traded securities, including the business information of a company, their financials, an outline of their officers and directors, including their compensation, and any other information that would contribute to the education of potential investors. Private Placement Memorandum. Now that we're familiar with what a PPO is and what a prospectus is, it's quite easy to understand what a Private Placement Memorandum is. A PPM is essentially a prospectus for shares in a private company. As one could assume, the PPM details the terms of the investment, it outlines requirements of the investor, discloses information related to the business, its debt, and equity. The main goal of the PPM is to inform the investor. Are PPMs necessary? Though revisions made to the SEC in 1992 eliminated requirements for companies to prepare a PPM for investors in order to make financing easier, experts suggest that it is still a good idea. And while there are no legal regulations, it is recommended that the level of disclosure should be comparable with applicable state and federal laws for securities. The Private Placement Memorandum is considered one of the most essential documents for entrepreneurs, second only to their business plan. PPMs are essential for entrepreneurs due to its association with a PPO, which is the most efficient path to producing equity financing. Due diligence. Due diligence is the process of gathering information which can be considered relevant in valuation of a business or company. The reasons for valuation could be various, be them for the selling of the assets, securities, equity, or the business as a whole. The uses for due diligence are twofold. First, most to the point, it is used as a way to inform the investor of any information for their accurate evaluation of the company. Secondly, it can be used as a method of protection, being unable to be held accountable for non-disclosure of information that was presented in the due diligence. Purpose of due diligence. When considering financial due diligence for a PPO, there are several areas to be considered. 1. To explain the reason for raising capital. 2. To explain the company's business model and budgets. And 3. A legal review. While it's often difficult to outline aspects of the business that can be perceived as negative when the goal is to raise capital, it is necessary, morally and legally, to paint as comprehensive and accurate a picture as possible. Who does a due diligence help? While it might seem more of a benefit to the investor to have an accurate due diligence, in reality, it's equally beneficial for both parties. It is important for both parties to have the most up-to-date and accurate financial information possible, not only to prevent the buyer from paying too much or the seller from receiving too little, but also to ensure that their authority and risk management goals are met. Term sheet. A term sheet is a document that outlines the material, terms, and conditions of a business agreement. It is established pre-funding and puts forth the expectations of both parties. Simply put, a term sheet lists the terms each party desires. What do term sheets accomplish? Term sheets are generally not legally binding, but are used as more of a middle ground for each party to lay out their expectations, which will initiate negotiations and lead to an ultimate agreement. While listing the terms and agreements, a term sheet also details the necessities of closing the deal. These could include due diligence, price, payment terms, valuation, and so on. Once the terms are agreed upon, both parties sign the document, and it is used as a basis for legal documents to be drawn by a lawyer. What does a term sheet include? A term sheet can include the investment amount, type of security, warrant coverage, pre-money valuation, ownership, management options, distributions, governance, consent requirements, as well as the exit. Goals of a term sheet. As is evident, the term sheet can be quite complex and extensive. Though many of the terms may seem harmless, it is wise to consider that the other side is always looking out for their best interest. Having a term sheet that both parties can agree on is an essential first step in a new business relationship.